Hello, welcome to this video about cost volume profit analysis. This is a chapter overview video. And in this chapter, we are going to look at how changes in volume affect costs. We're going to look at a new concept called contribution margin. We're going to use cost volume profit analysis for profit planning, for sensitivity analysis, and to calculate margin of safety and operating leverage. This is a very full chapter, so make sure you give it the time that it needs. So I've put stars on a bunch of these slides just to show you these are the most important concepts, so you want to make sure that you are very familiar with these. All right, so how changes in volume affect cost? This is the foundation of everything that's in this chapter, and also a lot of managerial accounting. For example, we'll see later budgeting and flexible budgeting all rely on this concept of variable and fixed costs. So variable costs are costs that change in total in direct proportion to changes in volume. We're going to take a look at what they look like. Fixed costs remain the same over wide ranges of volume. So that means that they don't change in total. And mixed costs have both a variable and mixed component. There's some notes here. You can see the cost behavior patterns video for more details. There are a lot of videos that go with this chapter. All right, so let's take a personal example, right? Let's say you love Starbucks and the drink that you love costs $4. I know that might be a little bit unrealistic, but let's just say that's the way it is. All right, so your total monthly Starbucks expense is a variable cost. It is based on how many coffees you buy. So remember what we said about variable costs. They change in direct proportion to changes in volume. So if the volume of coffee goes up, then your bill goes up, right? Your total coffee bill. Now notice here at the origin, this line begins at 0, meaning if you don't buy any Starbucks this month, then your bill is 0, okay? And so every coffee you buy makes your bill go up. There are many examples of variable costs in business, including things like direct materials and direct labor, right? If you're not making anything, you don't have to incur any direct materials costs. All right, now here is a key concept. The cost per cup of coffee stays constant. The total cost is going up as you buy more coffee. However, the cost per cup stays the same. So it doesn't matter how many you buy, the cost per cup is the same. So you remember that variable cost per unit, this is a variable cost per unit, stays the same. Write that down somewhere because it's really, really important. All right, now let's take a look at fixed costs. So we said fixed costs stay the same when volume increases. So it doesn't matter how many units you produce, your fixed costs stay the same. So example would be rent, right? Rent doesn't change. If you produce 0, you have to pay your rent. If you produce 100,000, you have to pay your rent, right? Until you get to a place where you're producing so many units that you have to rent another place or rent more space, right? So even though we say that fixed cost stays the same, it doesn't stay the same indefinitely, forever, no matter how many units, right? It stays the same within what we call the relevant range. So the relevant range is the range over which these assumptions remain valid, okay? So for the most part, rent, as long as you're within your relevant range, a fixed cost stays the same in total. Now, here's the interesting thing about fixed cost per unit. Cost per unit goes down when volume goes up, right? So think of an example. Let's do a simple example here. Let's say you produced 48,000 units and your rent is 48,000. So that means your rent per unit is $1. But what if we only produce 24,000 units? Well, then our rent per unit is $2. So I want to caution you, be very, very careful using fixed cost per unit. It is not something, it's very dangerous because as soon as you change your volume, your fixed cost per unit changes. All right, so generally we look at fixed costs in total and variable cost per unit. So then there's a thing called mixed costs, and mixed is both variable and fixed. So a mixed cost has a formula that looks like this. It's your variable cost per unit times the number of units plus your total fixed costs. So a very good example would be an electricity bill. So if you pay an electric bill, or if you don't, ask the person in your house that does. Electric bill has to be paid even if you're not using it at all. So at zero volume, you still have a cost, and that's the fixed cost component. Okay? So the difference between a mixed cost and a variable cost is that a variable cost is zero at zero volume, and a mixed cost always has a cost associated with it. So even if you don't use your electricity at all, you have to pay a certain amount just to keep it there. And then the more you use, the greater your bill gets. Okay? All right, so the high-low method is something that we use to separate mixed costs into their fixed and variable components for planning purposes. So remember, I just gave you the formula. Well, sometimes companies don't know their formula. They know, for example, that they've had bills that look like a certain amount and certain volume over a period of time, but they don't really know what their formula is, and they need to know their formula in order to plan and budget. So the high-low method is one way that we can use to separate costs into their fixed and variable components. Check out that separate video that walks you through it. It's a little bit technical. All right, now contribution margin, huge concept. There's a star here, right? Contribution margin is the amount contributed to covering your fixed costs and providing for profit. So contribution margin is used in a lot of different ways, and we want to just look at 3 different ways of calculating it or stating a contribution margin. So you can have total contribution margin, which is sales, total sales, minus total variable costs. You can have contribution margin per unit, which is selling price per unit minus variable cost per unit. You can also have contribution margin ratio, or a percentage, which is either your contribution margin per unit divided by your selling price per unit, or your total contribution margin divided by your total sales. So your ratio is basically your contribution margin as a percentage of sales. All right? Important, you need to memorize these 3 different ways of calculating contribution margin: sales minus variable cost, selling price minus variable cost. Now, we have a new format for the income statement called the contribution format. And this is what it looks like. Now, it starts with sales, just like all of our other income statements did, right? And it ends with operating income. In between, we have costs classified by behavior. So our sales here are $100,000. Our variable costs are $40,000. Sales minus variable costs equals contribution margin. That's $60,000. Minus your fixed costs gives you your operating income. Okay, so we're subtracting as we go down, just like we do on most income statements, right? Now, in this case, I also showed per unit just so you can see what it looks like. In this case, we're assuming that the company sold 10,000 units of product. And so per unit, it would be $10 selling price, a $4 variable cost, and $6 contribution margin. All right, so this is a new format of income statement. Again, you're going to have to be able to remember that. Now, let's look at the contribution margin ratio here, which remember is either contribution margin divided by sales or contribution margin per unit divided by selling price per unit. So this company's contribution margin is 60%. Now, break-even analysis. Break-even asks the question, at what volume will we have zero profit? All right, profit is zero. So revenues and expenses are exactly equal. And also, your total contribution margin equals your total fixed costs. Let's go back here a second. If we have zero profit here, then these 2 numbers must be equal. Okay? So contribution margin and fixed costs are exactly the same. So there's only one sales volume at which this is true, and this is called break-even point. Now, there are 2 different ways to calculate the break-even point. One is the equation approach, and that is just taking your sales revenue minus your variable costs minus your fixed costs equals your operating income. We set this at 0. And then you're going to solve depending on the information that you're given. All right, remember that at break-even point, operating income is 0. All right, a faster way to do this is to use the formulas, the contribution margin approach. Again, this has got a star. These are formulas you need to memorize. All right, so if you want to know how many units do we need to sell to break even, you use this first formula, break-even point in units sold. Take your total fixed costs and divide it by contribution margin per unit. And that gives you the number of units you need to sell to break even. Or, different formula, if you want to know how much break-even point is in total sales dollars, in other words, how many dollars of sales do we need to break even, you take your fixed costs and you divide it by your contribution margin ratio instead of your contribution margin per unit. So units, remember, units gives you unit per unit, right? Per unit gives you units, ratio gives you sales dollars. All right, now, of course, most companies don't want to break even. A lot of times if you're starting a business, you might be interested in knowing, well, where do we need to get to break even, right? But after that, companies are more likely to ask the question, how many units do we need to sell to earn a certain amount of profit? Because they want to earn profit. Now, these formulas are going to look very familiar because it's just like the break even we just looked at, except we're adding target profit to the numerator. So the contribution margin approach for target profit looks like this. If you want to know how many units you need to sell to earn a certain target profit, take your fixed costs, add your target profit, divide by contribution margin per unit. If you want to know sales dollars required, take your fixed costs, add your target profit, divide by contribution margin ratio. All right? Again, some more formulas. This chapter is filled with formulas. Get out your old-fashioned index cards, write them down, carry them around with you until you have them memorized. All right. Next up is sensitivity analysis. That's just asking the question, what happens if? So what happens if, for example, our selling prices increased, our variable costs go up, or fixed costs go down, all kinds of things like that. So how are these different kinds of changes going to affect profits? So I'm giving you two very simple examples here just to give you the idea. Let's say a change happens in your sales price only your sales price, nothing else. Now, of course, in real life, if you raise your sales price, what's going to happen? Chances are your sales are going to go down, but we're just assuming only the sales price is getting changed. So an increase in sales price is going to increase your profits, right? Because if everything else stays equal, your sales price goes up, your sales go up. Changes in variable or fixed costs are the opposite, right? If an increase happens in costs and nothing else changes, then your profits go down. But if your costs decrease, then your profits go up. And there are a lot of individual examples, and there are some in your other videos that will help you take a look at what happens when changes occur. All right, lastly, we're going to look at margin of safety and operating leverage. Again, you see some stars here. There is a video that will help you do some of this in detail. So margin of safety answers the question, how much can our sales decrease before losses occur? So it's kind of exactly what it sounds like. It's like a safety net. How much room do we have until we end up having losses? So there are three ways to express the margin of safety. One is in units. So in other words, how many units can our sales decrease before we have losses? And that is equal to our expected sales in units minus our break-even sales in units. Our margin of safety in dollars says how much can our sales dollars decrease before we have losses? And that's going to be expected sales in dollars minus your break-even sales in dollars. And then finally, if you want to state it as a ratio, you take your margin of safety in units and you divide it by your sales in units. All right, last up is operating leverage. So operating leverage looks at what happens to your profits or your operating income when your sales change. And what happens is the more fixed costs the company has, the greater its degree of operating leverage. And operating leverage is a two-edged sword because If you have a high operating leverage and your sales go up, woohoo, our profits go up by a lot. But if you have a high operating leverage and your sales go down, your profits go down a lot. So operating leverage looks at this proportion of fixed costs to variable costs. And it's calculated by taking total contribution margin and dividing it by operating income. And once you get that number, you can take that number, operating leverage, multiply it by the percentage change in sales, and that's going to give you your percentage change in operating income. Again, there's another video to help you out with that. All right, so that's all we have. You should be ready to hopefully start your chapter materials. Happy studying. I'll see you in the next video.